Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Today we are conducting a deep dive into two colossal global economies, the Eurozone and Japan. And these aren't just big players. They are, right now, ripping up their old economic blueprints and, well, replacing them with entirely new models. We're seeing these massive structural shifts happen in real time.
And it's so important for people to understand that these aren't your typical cyclical ups and downs. These are fundamental redefinitions. They're direct, necessary reactions to, a much more fragmented world, geopolitical tensions, and deep trade policy uncertainty.
Right, and the data we looked at specifically calls out the relevance of current U.S. trade policy, the Trump tariffs.
It does. I mean, basically, both Europe and Japan are abandoning the easy assumptions of the last, 30 years of globalization.
Yeah.
And they're building new economic structures designed to survive in a much tougher world.
Exactly. So our mission today is a two-part investigation. First, we'll dig into the collapse of Europe's traditional export-driven model and its kind of frantic pivot toward its internal market and defense.
And then second, we'll look at Japan's high-stakes, all-in strategy, a massive 39 trillion yen stimulus package. It's really an aggressive, state-mandated push for growth, almost no matter the fiscal cost.
Okay, let's unpack this first big worry. Europe. For decades, the German manufacturing sector was the engine of the Eurozone, no question.
Yeah, undisputed engine.
They exported, they built wealth, everyone benefited. But now, that engine seems to be seizing up. What is the official warning that's coming from European regulators?
Well, the official warning is maybe the clearest sign of the problem. The European Central Bank, the ECB, in its latest financial stability report, it named geopolitical tension and trade uncertainty, and they specifically referenced tariffs as the single biggest risk to Eurozone financial stability.
Wow, that's a huge claim. They're putting politics and trade above things like inflation or interest rates.
They are.
So how does geopolitical tension actually translate into financial instability for an average investor?
It's all about credit risk. See, Europe's biggest and best companies are incredibly export dependent. So when trade barriers go up or when global stress forces them to reroute their supply chains, their profits can just fall off a cliff.
Yeah.
So the ECB's big fear is that these lower corporate profits lead to a higher risk of default in the corporate bond market.
So it's not just a manufacturing problem, it's a potential system-wide infection.
Exactly. Think of it like a high-performance car. The engine, that's the manufacturing base, suddenly fails. Well, that failure puts enormous dangerous strain on the whole chassis, the brakes, everything.
The whole system.
The whole system. This manufacturing crisis is threatening to infect the wider financial system that really relies on those big exporters being profitable.
And we see that backed up by the hard data. I was looking at the November Eurozone manufacturing PMI, and the preliminary reading was a shocker, 45.2.
Mm-hmm. Just to remind everyone, anything below 50 is contraction. So 45.2 is, it's deeply entrenched stagnation.
But the truly shocking number was Germany specifically.
Yeah.
The data we have confirms that their manufacturing production has reverted to 2005 levels.
Right, 2005. Think about that. That's 2 decades of industrial progress just wiped out, gone, rendered irrelevant by the current global climate.
That's not a cyclical dip. That's a systemic failure of a business model. So if their main advantage, high-quality export manufacturing is gone, how is Europe even responding?
Their response is this big internal pivot. They're trying to fix what analysts have always called their internal market inefficiency. And the most aggressive move is this big push for a capital markets union, the CMU.
We hear that term, CMU, a lot. For our listeners, what is it actually supposed to do, practically speaking?
Okay, so historically, Europe runs on bank lending. It's very traditional, very slow. The U.S., on the other hand, relies on deep capital markets, stocks, bonds, venture capital, which are just way faster and better at funding new technology.
And European money flows to the U.S. market because of that.
Precisely. Right now, huge amounts of European private savings flow out to those stronger markets, mostly the U.S., because there just aren't enough high-growth opportunities at home. So the CMU is an attempt to stop that capital flight.
To stop that brain drain of capital, essentially.
You got it. The goal is to create one deep, integrated European market, to channel all that money internally into European startups, green industries, and this is critical, into defense and technology firms. It's about finding new growth by funding the future instead of just relying on the past.
Okay, so Europe is shrinking its focus and trying to build up its internal muscle. What does all this mean for someone investing globally? If the Eurozone engine is stalling, Where do you put your capital?
You really need a portfolio adjustment right now. The research points to 4 core insights. First, and this is a big one, avoid the structural short.
Okay, what's that?
The traditional European export giants.
Hmm.
Your Volkswagens, your BMWs, chemical companies like BASF, we'd call them a value trap.
But wait, those are historical behemoths. If their stocks look cheap right now, isn't that the definition of value investing? Shouldn't you buy them?
Not when the whole model is obsolete. See, this isn't cyclical cheapness, it's structural obsolescence. They are squeezed. On one side, you have cheaper state-backed competition from China. On the other, you have rising tariff barriers from the US.
They're stuck in the middle.
Totally stuck. They have to downsize or completely retool, so you need to reduce your long-term exposure there.
Understood. Sell the past. So what's the flip side?
Second, focus on internal strength. If the expert model is broken, you look inward. This means finding companies that benefit from that CMU integration we talk about, and overwhelmingly defense industry stocks.
Right, because of all the geopolitical risk.
Exactly. Perceived U.S. isolationism means European nations feel like they have to increase defense spending. It's structural, so companies like Rheinmetall or Thales are riding this guaranteed, multi-decade tailwind.
Betting on European rearmament. Makes sense. What's number 3?
Third, hunt for the global champions. We call these the de-Europeanized companies. These are firms headquartered in Europe, but they've already moved most of their revenue and production to safer, higher growth zones like the U.S. or India.
Can you give an example?
Sure. Think of a pharma leader like Novo Nordisk or Schneider Electric. They're basically insulated from all the Eurozone risks, but you still get that high-quality European management and innovation.
That's a clever way to get the expertise without the regional baggage.
It is. And finally, insight number 4. Hedge the currency. You have to prepare for sustained euro weakness. A fundamental economic decline almost always drives the currency down long term.
So you either hedge or...
Or you focus specifically on companies that actually benefit from a weak euro. Someone like Airbus, the aerospace giant. A weak euro makes their planes cheaper for global buyers, which helps them compete.
That European strategy, retreating inward, building defenses, is such a sharp contrast to our next subject. Let's shift over to Japan. They seem to be taking the exact opposite approach.
A completely opposite approach. An aggressive, all-in spending spree.
And this is where it gets really interesting. Tell us about the sheer scale of this package.
The scale is, well, it's staggering, and it really signals a change in philosophy. The Japanese government just confirmed a package with a final business scale of 39 trillion yen.
And what's that in US dollars, roughly?
It's about $250 billion US in new spending. And over 21 trillion of that is coming right from the general account, which just means it's debt-funded.
Japan already has a historic amount of national debt. So throwing that kind of money around is a bold move.
Yeah.
What was the political addition that really got analysts worried about the fiscal situation?
It wasn't just the spending, it was the tax cuts. They agreed to review and almost certainly raise the 1.03 million yen wall.
Okay, explain that. What is the 1.03 million yen wall for someone who doesn't follow Japanese policy?
It's a specific tax exemption limit. It mainly affects part-time and secondary earners, very often women. If you earn over that amount, about $10,000, you lose a key tax exemption. It creates this huge disincentive to work more hours or take a higher wage.
So raising it is a tax cut, but it's also more than that.
Much more. By signaling they'll raise this wall, the government is trying to stimulate consumption and tackle decades of stagnant wages. They're encouraging people to work and spend more. It's a signal that growth is the only goal now, no matter the debt.
And this creates a huge internal tension, right? This policy discord we hear about. The government is dumping fuel on the fire, but the central bank is supposed to be cooling inflation.
Absolutely. The data shows October CPI was 2.3% year over year. That's still above the 2% target. So the Bank of Japan, the BOJ, is under real pressure to finally end its zero-rate policy and tighten things up.
But they can't.
Well, how can the central bank raise rates effectively when the government is simultaneously flooding the economy with massive debt-fueled spending? It creates this conflict that the market sees as really destabilizing.
And we saw the market react.
We did. The yen-dollar exchange rate threatened 155, which signals bad yen weakness. Weakness from debt and confusion, not the good kind that just helps exports. At the same time, the 10-year Japanese government bond yield popped up to 1.09%, which shows the market is scared of all this future debt issuance.
So this isn't just random money printing. It is strategically directed. What are the three core state-mandated areas getting all this focus?
This strategy has a name, National Strategic Industry Nurturing, and Pillar 1 is absolutely massive, AI and semiconductors. Japan is setting up a 10 trillion yen long-term support framework through 2030. They are serious about building a domestic supply chain here.
And who benefits from that?
The key example cited is Rapidus, their new flagship chip maker, and all the related equipment and materials firms that support that industry.
A huge, decade-long commitment to high tech. What's Pillar 2?
Pillar 2 is energy security. The government is putting a new emphasis on nuclear power, restarting old plants, developing next-gen reactors. They know that all those new AI data centers are going to need a ton of stable, cheap electricity. You can't be a tech superpower if your power grid is weak.
And the third pillar?
Yeah.
It sounds a lot like Europe's focus.
It does, it mirrors it. The final pillar is more support for defense and shipbuilding. This is just part of Japan's ongoing rearmament trend, securing critical infrastructure to deal with geopolitical threats in their neighborhood. It's economic nationalism as national security.
So how should investors navigate this world of growth at all costs, where fiscal discipline has kind of gone out the window?
We have 4 key strategic insights here as well. First, embrace the bad yen weakness. Use it. The yen's weakness is structural, it's driven by debt, and it's here to stay. So you want to prioritize overseas revenue-heavy global export enterprises.
Like automakers and trading houses.
Exactly. Automotive, heavy machinery, the big trading houses. These firms earn in strong dollars or euros, but their costs are in cheap yen. So they make huge profits just from the currency translation when they bring their money home.
It's like buying global businesses that are priced in a heavily discounted currency.
That's a perfect way to put it. Second, follow the state mandate, or, as they say in Japan, the kokusaku. If the government is committing 10 trillion yen to something, you should probably invest there too. Focus on semiconductor equipment and materials and defense and heavy industry like Mitsubishi Heavy Industries.
Aid companies basically have a government guarantee on their future revenue.
It's as close as you can get.
Oh.
Third, and this is a key portfolio rotation idea, avoid bonds, buy banks.
Oh.
All this government debt issuance is terrible for Japanese government bond prices. It pushes interest rates up. But that very fact is excellent for large Japanese bank stocks.
Explain that. Why are higher rates good for banks after 30 years of zero rates?
It improves their net interest margin, their NIM. Think of NIM as the bank's profit spread. It's the difference between the interest they pay you for deposits and the interest they charge for loans.
And that spread was tiny for decades.
Almost zero. But as long-term rates rise, banks can charge much higher rates on mortgages and business loans, while the rates they pay out on savings accounts go up much more slowly. That widens the profit spread, and it structurally improves their profitability for the first time in a generation.
That makes perfect sense. They are the structural winners from the death of deflation. Okay, what's the last insight?
Inflation proofing. Japan is definitively leaving deflation behind. Holding cash, holding yen, is a losing strategy now. Investors need assets that hedge against that loss of purchasing power. This means strong consumer brands with pricing power, or hard assets like real estate REITs. You need to own things that benefit from rising prices.
So let's try to synthesize this huge global realignment. On one hand, you have Europe, on the other, you have Japan. Both are dismantling their old models.
Export-driven manufacturing in Europe, austerity and deflation in Japan.
And they're both replacing them with this structural defensive investment in technology, internal markets, and national security.
The central portfolio shift is, I think, unambiguous. You need to sell the past, the vulnerable European manufacturing giants or Japanese bonds in cash, and buy the future. And that future means defense stocks, strategic tech like AI, and those de-risked global champions that are insulated from all this regional instability.
It really is a moment where geopolitics is driving domestic policy, and that's defining investment returns. So here's a final thought to explore. Considering that both Europe and Japan are prioritizing defense spending and domestic industry because of all this geopolitical stress, what does this ongoing shift away from globalized supply chains and toward economic nationalism mean for the U.S. economy and our future trade relationships? Don't forget to subscribe and hit that like button.